So that sounds terribly exciting for everybody who loves silver. However, if you actually do go past the headline and read this gentleman's article and listen to his video, he is talking about an extreme period of volatility, and that if it were to happen that silver were to go to $300 per ounce, that you're probably better off selling your silver and cashing out of it while you can. Now, do I think silver can go to $300 per ounce? Look, crazier things have happened. I wouldn't be surprised to see silver at $100 per ounce, but if silver was $100 per ounce, I would actually expect a significantly higher gold price than $5,000 per ounce. And welcome back to Exponential Investor Podcast. I am your host, Shay Russell. And as you can see today, I am Samless, I am Elliotless, and I am also guestless. It is just me riding solo. Sam will be back with us next week, and I look forward to hearing what he's been up to. Now, before we get started today, I do apologize for the low quality recording of the video. I'm currently in Western Australia at the moment. And it turns out they don't have the internet here. They don't have a great internet here, so I've had to do it in a different way to make it happen and hope for the best. The upside is I do have a fire burning in the background, so I'm not complaining about that. All right, let's kick off with today. That's enough housekeeping. Now, you probably think, seeing that I've been on a commodities bent all week, that I'm going to talk about commodities today. And you would be absolutely incorrect if you thought that. Well, it would be consistent if I would do that. I am never consistent, and I can never stick to one train of thought. So what we are, in fact, going to talk about today is gold. Surprise, surprise. Look, my wheelhouse. I do love talking about gold. More than anything, there's just a couple of things that have come up this week, and I just sort of wanted to clear them up. So investors had realistic expectations and some facts around these things that are happening. Now, earlier in the week, depending on which financial rag you like to read, it was announced that the G7 are going to be banning gold exports from Russia. So basically, any of the G7 member countries have said that they will ban importing any gold from Russia. Now, let me read out a statement from Boris Johnson. I'm just going to go do a little bit of click in the background here. Forgive me. Upon the announcement, so Prime Minister Boris Johnson, your fearless leader, has said upon this announcement, or in the press release, whatever you want to call it, the measures we have announced today will directly hit Russian oligarchs and strike at the heart of Putin's war machine. Okay, I'm probably being slightly dramatic, but it is a very theatrical statement. It's also completely false. It's absolutely not going to strike the oligarchs and strike down Putin's war machine. It's not going to make an iota of difference. And here is why. Russia will sell their gold to somebody else. Like, this is really what it comes down to. So that's the short version. If you don't want to hear anything more about gold, you can stop there, come back next week when Sam's back. The long version is that gold is a little bit more nuanced than that. Now, let's just remember, it's the G7 member countries. Now, I probably should have looked up which ones they are, just so you know. The UK is one of them. Australia's absolutely not. So that's probably all you really need to know. Now, why won't it matter? Why is it largely symbolic? Well, the LBMA, the London Bullion Market Association, basically deregistered 400-ounce bars coming out of Russian refineries back in March or February when Russia invaded the Ukraine. So technically, nobody should be buying Russian gold anyway. Furthermore, rather than it should be going to Swiss refineries. Now, there was a report that 3 tons of Russian gold made its way to Swiss refineries in May. I actually don't have enough facts on hand to clear that one up for you to cover that off today. That might have been good information to have. But back to the point. Why doesn't it matter? Look, so a couple of things here. We'll start with the numbers. Now, Russia produces 363 tons of gold, or did produce 363 metric tons of gold in 2021. But while that was elevated on past years, it's pretty consistent of where it's been. Now, they export about 75% of their gold. They actually don't hoard their gold, unlike China. Now, China produces more gold than anybody else in the world. Russia's second, or Australia and Russia are fighting it out for second, but China produces the most. The difference is none of China's gold leaves China. It stays in China to be consumed in jewelry, to be consumed as a retail investment grade, or to be part of the Shanghai gold system. So the majority of Russia's gold actually does leave Russia. So this is where this goodwill gesture seems to make sense that, oh, yes, if, Russia exporting, $18 billion worth of gold will strike fear into their hearts by not buying it anymore. But here's the thing, that's very Western market centric thinking. And there are cultures around the world, outside the G7 that value gold and they really don't care where it comes from. So countries like India and China are enormous consumers of gold. Neither of them are in the G7. Neither of them have said they will adhere to the sanctions that have been placed against Russia by NATO members. So there's no reason to expect why they wouldn't go in there and mop up the gold that Russia's can't sell. Now, one argument being put forward is that the Central Bank of Russia is going to be a buyer and eventually this will strengthen Russia's balance sheet. Yes and no. You've got to remember that makes the Central Bank of Russia the buyer of last resort. Now, that didn't work out too well for the Central Bank of Russia when they actually had to buy gold at a discount to the spot market earlier in the year. It does mean that the Russian miners would probably be coerced into selling it to the Central Bank of Russia at a discount to the spot market again. Now, what that could lead to is Russian miners holding on to their gold for a considerable period of time. Obviously, they can't do that for too long because, they still need to sell the doré to bring money in, which is why I suspect that China and India are likely to come in and mop up any gold that can't be sold to Western markets. Now, there's a third part to this equation here, and that is the United Arab Emirates and other Arabic countries. Now, Dubai is a major gold hub in the world, and pretty much a lot of gold flows through there. And where its provenance is or where it comes from is very hard to track once it gets to Dubai because Dubai doesn't really follow the rules that the LBMA has set out. Now, there is, for anybody who wants to do some super sleuthing on this, the gold bugs love this. The LBMA and the Dubai gold markets have actually said that they don't care for the LBMA's rules and that they're not going to follow those rules because they don't think they actually match the gold market in Arabic countries. This could be a topic for another day. I'll get some more information. We might dive into that. But basically, Dubai has absolutely no problem absorbing gold out of Russia, and they'll be quite happy to do that. When will we know if this is happening? Well, gold data from the United Arab Emirates generally lags by about a year. So if it is happening, we're not going to know about it until maybe later in the year or even this time next year. The short version is it is highly likely that any exported gold from Russia is going to India, China, or via the United Arab Emirates. So that's pretty much it. So any grand gestures of the G7 members not buying gold, it's not going to do anything. Now, while we are on the subject of gold, we might delve on to something else that came up today, and it's sort of forms part of my thesis that I've been talking about or writing about really over the past few months, and that is silver's demonetization from gold, basically silver decoupling as money. I'll see if I can find some links and I'll pop them in the email that came with this podcast today. So over at PDAC, I didn't grab his name, but there was a guy who runs a website called Silver Stock Investor, and he's written a book and he's made a couple of really big claims that are fantastic for grabbing headlines, but I just want to talk about some of the truths behind it because, to his credit, he actually does try to hose down the hyperbole in the headlines. Now, one of his claims is that gold is easily going to $5,000 per ounce this decade, and that it'll take silver to $300 per ounce as well. Now, should that happen, there's a couple of bits to this. Should that happen, that's gold at $5,000 per ounce and silver at $300 per ounce. That would give you a gold to silver ratio of around 15-16. Now, the gold to silver ratio, for those of you who are new to this, is how many ounces of silver would it take to buy 1 ounce of gold. So to take 15, if it went to $5,000 per ounce, gold was $5,000 per ounce. Where's Sam when I need adult supervision? And silver at $300 per ounce. Then it would take 15 ounces of silver at $300 to go buy 1 ounce of gold. So that sounds terribly exciting for everybody who loves silver. However, if you actually do go past the headline and read this gentleman's article and listen to his video, he is talking about an extreme period of volatility, and that if it were to happen, that silver were to go to $300 per ounce, that you're probably better off selling your silver and cashing out of it while you can. Now, do I think silver can go to $300 per ounce? Look, crazier things have happened. I wouldn't be surprised to see silver at $100 per ounce. But if silver was $100 per ounce, I would actually expect a significantly higher gold price than $5,000 per ounce. And I don't think $5,000 per ounce for gold is impossible either. That's only a tripling of the price of where it is today. And when gold's in a bull market, it can actually do, 6 to 7 times its current spot price. So I think $5,000 is quite conservative. But let's get back to the gold to silver ratio thing. A lot of people do love this gold to silver ratio and love to talk about this reversion to the mean. Let's just clear something up here. Silver is rapidly becoming an industrial metal. I don't really see any reversion to the mean coming back. Like the long-term average is 55 to 60 ounces of silver to buy 1 ounce of gold. That's over a span of about 110 years. I don't really think that's realistic when silver, 50 to 55% of all silver is consumed for industrial purposes, and that's growing. The investor portion of the market takes anywhere from 15 to 20%. It's quite small. I would be very, very surprised to see silver ever go back to an extremely low ratio of 15 to 20 perhaps. If it did, I would say it would be fleeting, and us mere mortals outside of Wall Street are probably going to miss that moment. One thing I have written about in the past, and as I said, I'll pop a link in below for you, is that I see the gold to silver ratio actually increasing with time. So it's going to take more ounces of silver to buy gold. Now, this could be, basically my theory behind this is because I actually think gold is going to increase in value, but I believe it's because of silver's utility to society. That's going to prevent the price from rising too high as it decouples from acting like a precious metal and starts to behave like a commodity. So essentially the silver price is going to reflect industrial demand in the long term rather than being a precious metal. All right, we are nearly drawing to a close, but one thing I want to put on your radar, guys, I'm going to touch on the mining sector just a tad, fits in with commodities, what I've been talking about all week. Now, here in Australia, our financial year ended yesterday on the 30th of June. Now, in the UK, your financial year doesn't end until April next year. That's fine. But it is nearly half-yearly earning times coming up for you. So here's what our two periods have in common. So with the financial year ending in Australia and your half-yearly reporting coming up, there is some concern that miners' profits and expenses are going to have increased in Australia, reflecting this very turbulent March to June period, and it's going to hurt the value of mining shares. Now, one article I was reading today was talking about how all the inputs of getting stuff out of the ground have gone up. So let's talk about gold miners in particular. In Australia, the cost of cyanide's gone up 30%. The cost of, I don't think I wrote it down. The cost of natural gas has gone up 40%. The cost of skilled, knowledgeable geos and mining engineers has gone through the roof. We're looking at entry, first, second year graduates in Australia earning $170,000 per year on a mine site, which is phenomenal. 5 years ago, a geo with 20 years experience couldn't command that sort of income. And obviously, too, you're looking at energy as a key component to gold extraction. That's doubled in the past 5 months, as you know. So basically what the earnings season here in Australia is expecting that our mining stocks are going to be hit hard. Now, the question that I'm going to be looking for Australian investors is, how much of that has this, downtrend, these higher costs been factored into the share price? Because we know they're all selling off. And this is what UK investors should keep their eye on too. As you get closer to your half-yearly reporting season, let's keep our eye on how many of your mining stocks have been dragged down by higher energy costs. All right, that is probably the last little tidbit I have got for you today. I've got a whole bunch of stuff on my notes, but I think I've waffled on long enough. Now, hopefully Sam will be back next week, and I will have some guidance, and there will be less just random thought bubbles coming out. All right, that's all for your Exponential Investor podcast this week. To quote Sam, thanks for listening, and bye for now.